Have you ever wondered how Warren Buffett turned $114,000 into over $100 billion? That's not just wealth. That's a 900,000% return on investment. Today, I'm breaking down the Oracle of Omaha's investing secrets that the Wall Street elites don't want you to know. These are the exact principles that built one of the greatest fortunes in history during times of recession, inflation, and market crashes. The best part? You don't need fancy degrees or insider connections to use them. Stay with me for the next few minutes, and I promise you'll walk away with investment wisdom that took Buffett decades to perfect. If you're serious about building wealth like Warren Buffett, hit that like button right now and subscribe to the channel. Turn on notifications so you never miss future videos on building generational wealth. Now let's dive into the Buffett blueprint that can transform your financial future. Warren Buffett's entire investment philosophy can be summed up in one sentence. Price is what you pay, value is what you get. Unlike most investors who chase hot stocks and market trends, Buffett looks for businesses trading below their intrinsic value, essentially buying dollar bills for 60 cents. To put this into practice, stop following hype and FOMO-driven investments. Research companies thoroughly, focusing on fundamentals. Calculate a company's intrinsic value using discounted cash flow analysis. Only buy when there's a significant margin of safety between price and value. Hold for the long term, allowing compound interest to work its magic. Here's where most investors go wrong. They see stocks as lottery tickets, while Buffett sees them as businesses. When evaluating any investment, Buffett asks, would I want to own this entire business for the next 10+ years? This means focusing on companies with simple, understandable business models, consistent earnings history, and strong competitive advantages, competent and honest management teams, businesses that can withstand economic downturns, products or services with enduring demand. Remember when Buffett invested $1 billion in Coca-Cola in 1988? He wasn't betting on quarterly fluctuations. He understood that people would still be drinking Coke decades later. Never invest in a business you cannot understand. This might be Buffett's most powerful principle. While others jump into complicated tech startups or crypto projects they barely comprehend, Buffett sticks to businesses within his circle of competence. This is why, despite the dot-com boom of the late 90s, Buffett avoided tech stocks and subsequently avoided the devastating crash. He later admitted he didn't understand them well enough to value them properly. Ask yourself honestly, do you truly understand how the companies you're investing in make money? If not, you're not investing, you're speculating. Be fearful when others are greedy, and greedy when others are fearful. The average investor buys when markets are soaring at premium prices and sells during crashes at discount prices, exactly the opposite of what they should do. Buffett thrives on market panic. During the 2008 financial crisis, while everyone was selling in fear, he invested $5 billion in Goldman Sachs. That investment later yielded over $3 billion in profit. Developing this contrarian mindset requires creating an investment plan before market volatility hits, avoiding daily stock price checking and financial news overconsumption, understanding market history and the inevitability of cycles, having cash reserves ready for market downturns, and training yourself to see market crashes as sales, not disasters. The stock market is a device for transferring money from the impatient to the patient. In an age of day trading and quick profits, Buffett's average holding period for investments spans decades, not days. Consider his investment in American Express after the 1963 salad oil scandal crashed its stock. Buffett invested heavily when everyone thought the company might collapse. Today, that investment has increased over 160,000%. Patience manifests in waiting for the right opportunities, sometimes for years, holding quality investments through market volatility, allowing compound interest to build wealth exponentially, resisting the urge to do something during quiet periods, understanding that wealth building happens gradually, then suddenly. Diversification is protection against ignorance. It makes little sense if you know what you are doing. This might be Buffett's most controversial principle. While financial advisors push broad diversification, Buffett concentrates investments in his highest conviction ideas. At times, over 40% of Berkshire Hathaway's portfolio has been in a single stock, like Apple in recent years. This concentration allowed his best investments to meaningfully impact his returns. For the average investor, this means don't over-diversify to the point of diversification. Focus on your best ideas within your circle of competence. Understand that quality matters more than quantity. Build concentrated positions gradually, not all at once. Still, maintain enough diversification to sleep well at night. My wealth has come from a combination of living in America, some lucky genes, and compound interest. Buffett understands that the true power of investing comes from allowing your money to compound over long periods. Consider this. If you invested $10,000 and earned Buffett's historical returns of roughly 20% annually for 50 years, you'd have over $90 million. That's the miracle of compounding that Buffett has harnessed throughout his career. To build your own compounding machine, start investing as early as possible. Reinvest all dividends and capital gains. Minimize taxes by holding investments long-term. Avoid interrupting the compounding process with withdrawals. Think in terms of decades, not days. Warren Buffett's investing success isn't due to complex formulas or insider information. It comes from timeless principles applied with extraordinary discipline. By focusing on value, thinking like a business owner, staying within your circle of competence, maintaining emotional discipline, practicing patience, concentrating investments wisely, and harnessing the power of compounding, you can build wealth like Buffett. Remember, Buffett started with modest means just like most of us. His superpower wasn't access to special opportunities. It was his adherence to these principles through all market conditions. Whether you're starting with $100 or $100,000, these same principles can guide your investing journey. If you found value in these Buffett investing principles, hit that like button right now. It helps this video reach more investors who need this guidance in today's volatile markets. And subscribe to join our investing community where we break down timeless wisdom like this every week. Turn on notifications so you never miss our next analysis of legendary investors like Buffett. Drop a comment below with your favorite Buffett principle or a question about how to apply his wisdom to today's market conditions. Until next time, remember Buffett's most important lesson. The best investment you can make is in yourself and your financial education. See you in the next video.